Good morning, everybody in Europe. Good afternoon to those who listen to us from China. Welcome to the EU SME Center webinar series, today on corporate income tax. Before we move to our today's topic, let me firstly shortly draw your attention to some technical issues. First one is on your screen you can see small panel. You can see the small panel which is meant for your questions. So during the webinar, please do not hesitate and send to us any question you might have. We will reply either during the webinar or at the end during the Q&A section. If you are joining us for the first time, please firstly let me introduce to you shortly USME Center and about our background. USME Center is a project which is funded by the European Union, and its main aim is to help small and medium-sized enterprises from Europe to invest to China or export their products or services to China. All our services are free of charge, and we are helping companies by providing advice and reply to their inquiries. We as well published more than 80 publications, which all of them are available at our websites and are ready to be downloaded. You can send us any question via the email, or you can call us. We do as well trainings and the webinars every Tuesday, like these ones. We provide as well databases, which is one of those databases is exhibition database, service providers database, and database of the laws. If it happens that you will come to China, and specifically in Beijing, you can as well spend some time with us and use our offices and meeting rooms for hot desking. Now let's move to our today's topic, which is on a corporate income tax. USME Center has decided to devote a few webinars to the tax issues because we see it as a very important topics. Tax topics are always complex. Therefore, for this corporate income tax, we will start with introduction of important terminology, and then we will explain it on the several practical case studies. For this topic, we have today invited Mrs. Grace Yin. Mrs. Grace Yin is a senior manager and in a tax and a business advisory working in Ernst & Young in Beijing. Grace began her tax career in 2005, so he has a very long experience with providing advice and consultation to various companies on tax issues. Grace, she worked in SAFE, which is State Administration of Foreign Exchange, and he is a member of CPA in Australia. So please let me now pass the word to her.
Hello, good morning and good afternoon, everybody. I'm quite honored to be here to attend the seminar today. Our topic today actually will cover three parts. So in the first part, we just trying to give you some basic regulatory framework about the corporate income tax in China, including the tax resident concept and also the taxable income, and also how to apply for the double tax treaties. And the second part is we'll just try and give you some practical examples about the typical tax issues you may be facing in China. And the third part is just give you some recent regulatory development in relation to the outward remittance issue. So let's go to the first part is talk about the who is obligated to pay and from what income for the corporate income tax purpose. So the first question is, what about the tax resident in China? So under the corporate income tax law in China, the taxpayer just be divided into the resident enterprise and the non-resident enterprise. So in order to determine the concept of the tax resident, we need to look at the two criteria. The first one is the place of the registration or the incorporation, and the second one is the place of the effective management. So you can see from the left-hand side of the slides, the first one is the resident enterprise. Is including the two scenario. The first one is legally the company is established in the PRC under the PRC laws, or a company may not be established under the Chinese law. It's just established under the foreign country's law, but whose place of effective management is actually located in PRC. In that case, it's also may be the PRC tax resident enterprise. And the second type of taxpayer is a non-resident enterprise. It's also included two scenarios. First one is typically is established under the law of foreign country, but its place of management located also outside of the PRC. The key item here is the establishment issue. That means if the foreign company just have an establishment or place of business in China as a non-resident enterprise, it still may be subject to corporate income tax in China. The other scenario is if the non-resident company, that means is establishment under the foreign law, which does not have the establishment or any place of business in PRC, but it still could be derive some income from China, which is the China source income. So for that kind of China source income, the foreign company may still be subject to corporate income tax in China. So we will give more example and some more explanation in the later stage. And in terms of the taxable income, the typical difference between the resident enterprise and the non-resident enterprise is the scope of the taxable income. So for the resident enterprise, their taxable income should be included their global income. That means all the income derived by the resident enterprise within and outside of PRC. So let's do a case study here. Just give you a more example to understand the issue of the effective management test. So under this case, you just see Hong Kong company B as the parent company, and then the Hong Kong company just set up two subsidiaries in PRC, which is wholly owned by the Hong Kong company B. In terms of their business operation, normally the board meetings will be held in Hong Kong, but their senior executive may be located in PRC, and maybe someone is the PRC nationality, and they just are directing the day-to-day business operation of the group. In real case, some foreign company, when they choose to investment into China, maybe they just set up in between company as an investment holding company. Typically, they may choose the Hong Kong company as the holding company, and then to set up the PRC company. So in our case, our question is, if the two PRC company just distribute the dividend to the Hong Kong company, whether the dividend received by the Hong Kong company will be subject to the PRC tax in that scenario. So the first question is, maybe we look at the type of the income. Is the dividend income actually is a passive income derived by the Hong Kong company? And another issue is the whether the Hong Kong company have some effective management in China. So when we're doing such kind of test, actually the existing regulatory framework just provide for conditions. But that circular actually is just apply for the foreign registered China control enterprise, not exactly for the purely foreign investment overseas company. But when we talking about effective management issue, we can still take it as a reference. So I just briefly go through the 4 criteria. So basically, it depends on the place where the senior management and the senior management department are located. And the second one is the financial decision and the personnel decision. The third one is the main asset, accounting books, and the corporate sales, and the board of directors location, and also included where the shareholders meeting will be held. And the last one is the whether 1/2 or more of the directors or senior management staff have the right to vote actually located in the territory of China. So normally all of 4 conditions are met. The foreign company is possible to be determined as effective management in China, and then to be deemed as a PRC tax resident. If the foreign company is determined as a PRC tax resident, the consequence is its global income will be subject to tax in PRC. So let's just go to detail about the resident enterprise and also the non-resident enterprise. So firstly, we just a brief introduction about the resident enterprise. As we just mentioned, for the resident enterprise, their global income is subject to the corporate income tax in China. So the first issue is how to calculate the taxable income. Basically, the taxable income actually is equal to the total income. That means normally the gross income show in the P&L. To deduct it, several items. Normally, the first one is the non-taxable income. That may include funds allocated under public finance. And the second deductible item is the tax-exempted income. For example, the government bond interest. And the third deductible item is normally the other deduction item, including the expenditure incurred by the company, but the expenditure should be reasonable and related to the business operation. And the last one is the you need to making up the losses from the previous years. So we can just generate the taxable income based on that formula. And the other principal rules we just want to mention here included not like most European country or US country. For China tax purpose, there is no distinction between the ordinary business income and the capital gains. So that means all kind of income should be included as the total income for the same corporate income tax rate. And the second point is the losses incurred by the resident enterprise can be carried forward for 5 years without any restrictions, but the losses cannot be carried back. So you can just use the losses in your future operation, cannot just be carried back. And the third principle is the deductible item. As we just mentioned, only the expenditure which is connected with the income generated can be deducted. And also, based on the corporate income tax law, the reasonable expenditure means the first one is necessary, and the second one is the normal expenditure, which are spent on the normal activity of the production and operation. And the last point is about the overseas income. So that means if the resident enterprise just derive the overseas income, that should be included in the taxable income for corporate income tax purpose, and also for the calculation about the corporate income tax liability, foreign income tax already paid, that could be deductible or credit when we calculate the corporate income tax payable of the resident enterprise.
May I have just a very short question? Do I understand it correctly that if I have a, let's say, buffet in China and my clients are in Hong Kong or overseas and I provide services to them, that it is as well included into the taxable income?
Yeah.
Yeah.
Yeah. For sure, that the income derived by the PRC company from Hong Kong should be also included in their taxable income. But if that kind of income has been taxed in Hong Kong, so the Hong Kong tax, especially in the income tax nature paid in Hong Kong, could be take a credit when they calculating their PRC tax liability. Yeah. The second point we want to discuss about the resident enterprise is about the tax rate. So from 2008, China just introduced the new corporate income tax law. So currently the statutory corporate income tax rate is 25%. So we also understand there are some exemption or reduction provided here. For example, reduce the corporate income tax for the high new technology enterprise could be reduced to 50%, and for the low profit enterprise could be reduced to 20%. We just give you some table about the definition of the low profit enterprise. So basically, just determine based on their number of employees and the total asset number, and also the annual taxable income. Another issue is about the tax holiday. So before the foreign company just understand the PRC tax authority and the PRC government just provide some tax holiday to the foreign invested enterprise. But under the new corporate income tax law, the only tax holiday actually is provided to the qualified high new technology enterprise newly established in the special economic zone, such as Shenzhen, Zhuhai, Shantou, Xiamen, and Hainan. And also, if the company is newly established in the Shanghai Pudong new area, after 2008, the enterprise also can apply for to be entitled to a 2 years tax exemption plus 3 years tax rate half deduction for the from the fourth year when they derive the operating income. Another things maybe faced by the resident enterprise is we are talking about the tax filing and the payment issue. So typically the enterprise should be file quarterly or monthly provisional corporate income tax returns in respect their advanced corporate income tax payment. Another thing is the enterprise is also required to file annual corporate income tax returns between before 31st May of each year. So normally there is no extension is approved or granted by the tax authority. So just pay attention to the timeline for the tax payment. The third point is we would like to talk is the quarterly corporate income tax payable and the CIT payable in relation to the annual tax filing shall be allocated among the head office and the branches. So for example, if a WUFI just set up several different branches in Beijing, in Shanghai, or other location, when they calculate the quarterly corporate income tax payable and their annual filing, all the taxable income and all the tax payment should be allocated based on certain allocation ratio. The last thing is under the current corporate income tax regime, it is not allowable to perform a consolidated corporate income tax filing between two separate legal entities. That may be allowable for some European country, but for China, each legal entity just need to perform a separate corporate income tax filing. That means if a foreign company just have two, for example, two offices in China, one is in the loss position and another just to get the profit, but the profit entity may not be able to utilize the loss generated by the other office.
Thank you, Grace. So this part we have finished first about resident enterprises, and before we move to another one about non-resident enterprises, let me launch our first poll for today and see your opinion on the question. And it is mainly the question for those who are non-residents. And the question is whether your company faces any troubles when being paid or when getting payment from China due to the tax clearance issues. And I can see your votes coming, and the first one is yes, tax authorities takes always time to assess tax implications. Second option was yes, withholding agent failed to help us negotiate good position. And a third option, no, we have no troubles at all. So just a few seconds more, and then I will close the polls. And let's see the results. So 38% of you saying that you have troubles because tax authorities take time to assess the tax implications, and 63 have no troubles at all, and there was no vote for the second option, withholding agent failed to negotiate. Yeah. So what's your, Grace, what is your opinion on these results? Does it correspond to your experience, to your practice?
I just think the result is amazing. Of course, just almost 40% face the challenge from the tax authority. But in our case, we just see a lot of trouble faced by the taxpayer, especially for the non-resident enterprise. Maybe one reason is they don't quite understand the legal framework of China, and also it quite depends on how cooperative about their Chinese counterparty. So I think it's a good thing. And maybe we can just share something about the corporate income tax compliance issue about the non-resident enterprise, just help the other 40% people to improve the tax compliance status in China. Yeah.
Just allow me one interruption. We have one question. We are talking about PRC, and there was a question what PRC means. It means People's Republic of China. So when you see a PRC, it's about China.
We will talk about it later. And actually, the corporate income tax rate for the non-resident enterprise should normally should be 10%, but it also depends on the nature of the income. So we can just go through that later. Yeah.
Yeah.
Yeah. So the first thing when we're talking about the non-resident enterprise is actually what kind of income would be subject to income tax in China. So in that table, we just put different scenario here. So for the foreign company, they're not incorporating in China and without any effective arrangement in PRC. So whether it will be subject to corporate income tax China, it depends on whether they have the PRC establishment and also whether there is any other income is connected with the PRC establishment. So in the first column, when we're talking about the foreign company with the PRC establishment, so their China source income and also the connected non-PRC source income connected with the PRC establishment will be subject to corporate income tax in China. The other scenario is if the foreign company, they don't have the PRC establishment, but they have some passive income, that kind of PRC source income will also subject to the PRC corporate income tax. The second question may be how to determine the China source income. So we just put a table here, provide some different type of income, including, for example, to sales of goods, to provision of services, or transfer of property, derived dividends, something like that. So I think most of the revenue may be derived by the foreign company is the provision of services. So let's put that as an example. So if the foreign company just provide services to Chinese company, so the place where the services are provided should be looked at to determine whether the income is China source income. That means if the place of services actually provided in China, so that income is China source income. We just got a question about the corporate income tax rate for non-resident. So if you look at these slides, the PRC source income could be generally divided as the active income and the passive income. So active income typically something like the provision of services, some construction, installation. And as we just discussed in the last slides, for the active income, only one foreign company to be determined to have a permanent establishment in China, their income from China will be subject to PRC tax at 25%. And for the passive income, is typically something like the dividend, interest, royalty income, capital gains. So for that kind of passive income, the taxable income tax rate is 10%, and also could be eligible for some treaty reduction for the tax rate. The following slides, we just want to go through some withholding issue, tax filing issue, and the typical registration requirement. In the interest of time, we just quickly go through that. So for the registration requirements, typically is all obligation of the Chinese payer. So normally when the contract is concluded, the Chinese payer and the Chinese service recipient should perform a contract registration within 30 days. The second thing should be bear in mind is the withholding obligation. So normally when we're talking about the passive income under the corporate income tax law in China, the Chinese payer has the legally obligation to do the tax withholding before they do the payment to the service provider. So just bear in mind the withholding obligation is borne by the resident payer. Normally, if the withholding agent do not just perform their withholding obligation, there should be some penalty for the non-compliance. And also for the tax filing and the requirements, simply to understand, for remittance purpose, the Chinese payer also need to perform a tax record filing. That's I should say that's a formality issue, just separate about the tax payment. So normally, when the Chinese withholding agent just perform the tax payment, they need to separately apply for a tax record filing form. That form will be provided to the bank for the remittance purpose. Another issue may be faced by the non-resident company is about their tax payment. So normally, if the Chinese withholding agent files to perform the tax payment, the non-resident need to perform the tax filing and to do the payment by themselves. So in that case, the non-resident need to make the foreign remittance to a special account of the tax authority for tax settlement purpose. The next topic. Sorry, the next topic we will cover is talking about the active income derived by the non-resident and the permanent establishment issue. So, put it simple, actually, the income I mean the active income, which would be subject to PRC tax, is related to whether the foreign company just to be deemed to have a permanent establishment in China. So there are two kind of definition. The first one is provided by the corporate income tax law. That means establishment or place in China to engage in production and the business operation. But just above the PRC domestic law, the foreign company may also refer to the definition provided in the Double Tax Treaty. The Double Tax Treaty provided more detailed definition about the PE issue. So currently, we just understand the 28 EU countries have all of them have entered into the Double Tax Treaty with China. So current status is some of the Double Tax Treaty between China and the EU country is just signed in 1980 something. So they are just being renegotiated, and some has been signed but just waiting for ratified. To better to understand the PE issue, we just put a case study here. So in that case, you just see European country A, they may just have a warehouse in China and to storage some goods, which will be further delivered to the third party and also delivered to the customer. The customer is actually located in China. So in that deal, the contract negotiation and the conclusion may be just via the email or the fax. So that means nobody will go to China for the contract negotiation conclusion. The only person maybe just go to China is the Mr. N of the European company. They may just be sent to China for general sales liaison and some promotion activity, and the duration may just have a single trip for 3 months. So in that case, the question is whether the European company will be deemed to have a permanent establishment in China. Typically, the first question is whether the warehouse itself can be a fixed place of a business in China. It quite depends on the function of the warehouse. So put it simple, if the warehouse just for storage purpose, it may not be necessary to be a permanent establishment in China. So the second one, the second thinking point is whether the European company send a person to China on a request basis for 3 months duration, maybe to be considered as a PE. Basically based on the treaty articles for that kind of person, if they just to be sent into China for 3 months, they may not be necessary to be determined as a PE. Of course, as provided under the normal double tax treaty between the foreign company and China, the threshold is normally 180 days or 3 months or 6 months. Another issue is the negotiation and conclusion. If the negotiation and conclusion of the contract just via email, that means no person just physically to be assigned or no to authorized to be the authorized person to sign the contract. I would say it should be safe. That means the European company should not be able to determine as a PE. The next slides where we just put some formula about how to calculate the taxable income in relation to the active income. The basic principle is depends on whether the foreign company can calculate and declare the taxable income accurately. If not, just choose one of the method here. Basically, the method we just talking about is some deemed profit rate method. So how to determine the deemed profit rate depends on the nature of the services. Normally, if for design service or consulting service, is within the range 50% to 30%, and for the management service is typically 30% to 50%. For others, maybe just no less than 50%.
Let me interrupt you here, Grace. So what if I think that the Chinese tax office calculated in a non-correct way? What shall I do, or is there anything I can do?
Yeah. For the active income, we just see a lot of case. The taxpayer have some bias or some challenges with the tax authority. We just suggest when you determine the PE status and also the profit rate and also the taxable income, that should be considered more proactively. That means not just waiting for the tax authority to give you the tax income number and then to argue with them. Normally, there just a little space to do the argument with the tax authority, just proactively to prepare the supporting document to justify the tax assessment.
Thank you.
And the last thing we are talking about is about the active income derived by the non-resident, how they're doing the filing and the registration. Again, there are several stages. The first one is to do the contract registration, and then the non-resident enterprise itself or the withholding agent they engage will perform the corporate income tax filing. So that's all the procedure. And another issue we're just talking about is the foreign company, the non-resident company. They may be eligible to enjoy the double tax treaty. So we're just talking about some rules about how to apply for enjoying the double tax treaty. So over the last few years, the Chinese tax authority just issued some regulation to prevent the tax treaty shopping. So from procedure-wise, in order to claiming the tax treaty benefit, it also depends on the nature of income. So typically for the active income, for example, the business profit or other applicable income, the taxpayer just required to perform a record filing with the tax authority. That means you just registration of the contract with the tax authority for claiming tax treaty purpose. That should be fine. The other type of income we just talking about is the passive income, something like the dividend, interest, royalty. For that kind of income to claiming the tax treaty benefit, it just required to get a pre-approval from the tax authority. But the good things is when the approval is granted, it's just valid for 3 years. The typical document required is something like the tax resident certificate of the treaty country, something like that. But the other issue is when we're talking about the passive income, the PRC tax authority just introduced the concept of the beneficiary ownership. It's quite popular in the European country and the other U.S. country, in the U.S. So the beneficiary owner for the treaty purpose just means to have the legal and also the economic ownership of the dividend, interest, and royalty income. So, as well as they may have the right to give rise some income. So, when the taxpayer is applying for the treaty benefit, the tax authority will more focus on their beneficiary ownership status. So the basic principle will be applied by the PRC tax authority is actually a substance over form test, and also the relevant regulation just provide a list of some unfavorable factors may be considered by the tax authority. But last but not least, an important factor appeared here is the amount of the business activity and the business substance of the income recipients. Let's see an example. When we're talking about the beneficial ownership, just look at that picture. So we just put a foreign company as the parent company, and also have some SPV, for example, in Hong Kong, and then to set up a PRC company. So when the PRC company just distribute the dividend to the SPV in Hong Kong, so when they apply for the tax treaty benefit, the PRC tax authority will look at the status of the SPV. So normally, if the SPV just as an investment holding company, they don't have the staff, they don't have the asset, and they don't have the real business operation, it's most likely the tax authority will just determine the SPV as a conduit company. So the consequence is the tax authority may look through that SPV and then just treat the distribution, the dividend distribution is actually to the parent company. The question may happen here. Of course, you may asking if the SPV was looked through whether the PRC tax treaty with the parent company jurisdiction can be applied. That's actually a good question, but I would see currently, based on the current regulation, they don't provide a clear guidance. And we also have some real case like this, and we try to discuss with different interest tax bureau to just try to apply for the tax treaty between China and the parent company. And also in real case, there are some successful case here. Yeah.
Okay, so I think that the preceding picture clearly showed the usual or very often case when the SPV is established in Hong Kong and the companies are trying to use the preferential 5% rate. So it's not that easy to to use. I think that now is time for the second poll, and the second poll is related to what kinds of income derived by overseas enterprises from China face challenge from PRC tax authorities more frequently. So we would like to know your opinion. What do you think? What is the most troublesome? Is it a technical service fee, or intercompany charges, or royalty, or costs paid on behalf by overseas? Just give us your ideas. What do you think? And we will have then qualified opinion of our today's speaker. Okay, so I will close the polls and share the results with you. So 27% of you think it's technical service fee, 40% voted for intercompany charges, 13% for royalty, and 20% for costs paid on behalf of by overseas companies. So winner is the intercompany charges. Grace, what is your expertise saying?
That's actually quite same with our real experience. So most of the company just facing the typical tax issue is related to the technical service fee and the royalty payment, and another issue is typically the intercompany charges. So our today's topic, just would like to talk more about that. Okay, as the poll just show, the typical issue for the income derived by the non-resident is the technical service fee, royalty, management fee allocation, and some expense paid on behalf. So today's we just choose some common issues here. So first one is related to the technical service fee, whereas the royalty fee. So typically for the royalty income, if we look at the tax treaty, they just define the royalty payment is related to the use of industrial, commercial, and science equipment as the royalty, and also the beneficial treaty benefit withholding tax rate should be applied here. when we're talking about how to differentiate the royalty payment and the service payment, actually for the PRC tax authority, the factors to be considered by them included whether the first one is whether the payment is related to the licensor's licensing preparatory technology for use of the licensee. That means whether it is not involved in the implementation of the licensing of the technology. So normally, if the implementation of the technology is not involved, that should be considered as a royalty. And the second considered point is the license technology, whether there normally is an existing technology, but also it may also including some technology development based on the licensee's needs with some confidential restrictions. So just as a summary, if we look at the key consideration of the tax authority, just put it simple, 3 points. The first one is whether the result of the work fall within the scope of royalty provided by the double tax treaty. So the double tax treaty just provide the royalty definition as some information concerning industrial, commercial, and scientific experience. And the second point is whether the service provider is the owner of the work result. That means if the service provider just keeps the ownership of the work, so that should be treated as a royalty. And the third criteria is the service recipient. They just have the right to use the work result, so they cannot just control the result. We better to have a case study here to let you better understanding the differentiation between the technology service fee and the royalty. So in that case, the foreign company is the F. So the F company just assign agreement with the PRC company A. It is actually a technology importation agreement. So the scope of services just include to design equipment and also to provide relevant technology supporting services. And for provision of the technology services, the F company will assign some engineer to China to provide onshore service for 2 months. So in that case, the question is, will the design and the technology service fee derived by the F company is in the royalty nature, and further whether it will be subject to corporate income tax in China. So that is the real case. We just understand the F company when they talking about when they talk with the tax authority, they just argue their equipment design services is not royalty. Of course, they just customize some ideas to fulfill the client's requirements. It's not already done products that can be provided. But during the investigation by the tax authority, they just do some research from the website of the F company, and the tax authority understand that kind of equipment designed by the F company is a quite mature product, and the design plan is also quite mature. So the PRC company just thought that F company have the experience and they have the information of the industrial to design the equipment. So in that case, finally the tax authority just determined the equipment design service fee derived by the F company is in royalty nature. And also some key consideration here by the tax authority is actually the rise. Just as we put in the slides, the PRC-A company, in that case, based on the agreement, they just have the usage right to the design work result. And it's clearly to state in the agreement that F company is still the owner of the work result. I think that's also another key point considered by the tax authority to determine the revenue derived by the F company is in royalty nature. Another issue maybe faced by foreign company typically is the technical service fee. In the case study here, the agreement also including part of the technology service fee. Based on the scenario, the F company just assigned the person to provide onshore services for 2 months. So you can just see it's not meet the normally criteria provided by the double tax treaty. Of course, the treaty provider threshold is normally 6 months or 180 days. So just provide onshore service for 2 months is not necessary to be determined have a PE in the PRC. So if the F company is not establishment a PE in China, it will not be subject to PRC tax in China. But in that case, the tax authority just evoke another regulation. The specific regulation just said if the technology supporting services is related to the importation of technology itself, so that kind of technology service fee should also be deemed as a royalty fee in nature. So in that case, the technical service fee actually is related to the equipment design service. So finally, the technical service fee is also being included in the royalty fee and then subject to the corporate income tax in China. Another issue, typical issue is, as we just mentioned in the poll, is about intercompany charge. One type of charge between the company may be related to the management fee or the cost sharing. So basically, based on the corporate income tax law, the management fee paid between the enterprise, rentals or royalty paid between the business establishment within the enterprise, and the interest paid between the intergroup company. That's all kind of payment between the intercompany may not be deducted for corporate income tax purpose. That means we just look at the tax issue. If the intercompany fee can be paid, for example, the management fee can be paid from a China WFOE to a foreign company, but the fee itself cannot be deducted as expenses for the WFOE as a deductible item for the corporate income tax calculation purpose. So it's actually a loss for the WFOE. So the question is how to determine what kind of intercompany charges can be deductible for corporate income tax purpose. So we just look at some real case, especially for some multinational company. They just have some back office function in overseas, just centralize some back office service. And also for some IT equipment procurement, they just use one overseas company to do all the procurement at one point. But for the financial purpose, they may allocate that kind of cost to different enterprise, the different group enterprise in different location. But for China, we may just suggest if intercompany just incurs that kind of cost allocation or cost sharing, the agreement itself and also the payment should be supported by sufficient supporting document to justify the cost is related to the profit generation of the WFOE. So if the Chinese company can justify the cost allocation here is related to their business operation, or the expenditure itself could be incurred by the WFOE themselves, so it could be argued with the tax authority to take the tax deduction for corporate income tax purpose. The last topic here is the recent regulation development related to the outward remittance. So you may just see here the government authority, especially the State Administration for Exchange and the tax authority, just issue some new regulations to simplify the procedure. So typically, currently for the remittance to overseas, SAFE approval is not required. And for the single payment, if the payment amount exceed US dollar 50,000, so in that case, the Chinese payer just need to get a tax filing record form from the tax authority. So that just simplify the previous tax clearance procedure. So under the new regulation framework, you may just ask whether the tax risk under the new procedure is just reduced. But unfortunately, shift from the previous approval procedure to the post remittance examination procedure, they just may add the tax burden or some administration burden to the taxpayer itself, because during the post-remittance examination, the tax authority and also including the SAFE, they also is eligible to impose some penalty or surcharge for the unpaid taxes. In terms of the procedure, you just see we just talk about to simplify the procedure to the tax filing record, but in practice, we just understand it's not just that of simple. The tax authority just also require the taxpayer to perform the contract registration, tax assessment, and also to do the tax filing. That means in that flow chart, only when the tax withholding agent to perform the tax filing and the tax payment, the Chinese payer can get the tax record filing form for remittance purpose. So we just get a summary of today's discussion. So when we're talking about the corporate income tax implication in China, we just need to consider several points. First one is the P issue, and also for intercompany charge, we may also consider the transfer pricing issue. We not talk about too much here. It's actually a quite complicated topic. The third one is we talk a lot about the tax compliance issue, about the procedure, and also the foreign company may just look at the foreign exchange administration and some control in China. Just take that full kind of consideration before you're doing the business operation in China.
Thank you very much, Grace. There is really a lot what can be said about enterprise income tax and much more. And today it was really a very brief overview and focusing on some common issues and often issues which resident enterprises or non-resident enterprises faces. We have received quite a lot of questions. To those who send us questions, please do not worry. We will address all of them, and we will send separate emails to you, and so you will get your answers. As well, we are aware there was a lot of information, so this, as usually, all these slides and recording of the webinar will be placed on our websites, usmecenter.org.cn. So if you are registered, they will be freely downloadable. If you are not, please register to our website. It's free of charge. And in addition to these slides, you will have access to other webinars, all our previous webinars, and all the publications which we are providing free of charge. Next week, this time Tuesday, from 5 to 6 Chinese time and from 10 to 11 European time, we will have a webinar as well. And it will be a webinar on corporate social responsibility. So if you are interested in this topic, please join us. We will be happy, very happy. So have a nice day or have a nice evening, and thanks for joining us.